Good afternoon, everyone. Welcome to our program entitled The IRS Final Report on Nonprofit Colleges and Universities, Lessons for All Tax-Exempt Organizations. Welcome to Venable. My name is Jeff Tenenbaum, Chair of the Nonprofit Organizations Practice here at the Venable Law Firm. Welcome to our monthly program here today. It's actually the second one that we've done this month. You got a bonus program. This is part of a series of monthly seminars and webinars that we do on a wide array of various nonprofit legal topics. Today's topic kind of takes us back to really what is the core of any nonprofit legal practice, and that's the law governing tax-exempt organizations. As you know, and for those of you who, many of you do, come to our monthly luncheons and read our alerts and other content that we put out, nonprofit law covers a very, very wide array of diverse legal topics. But underlying everything that a nonprofit tax-exempt organization does is the section of the Internal Revenue Code that regulates what tax-exempt organizations can and can't do. And it really does infiltrate every aspect of your operations. It has a bearing on almost every contract that you enter into and on so many other things that a nonprofit gets involved in. So it's an area that's critically important. And for many nonprofits, if they were to lose their tax-exempt status, it would likely mean game over and no more organization. So it really is a very, very important area of the law, and we're pleased to be able to focus on this today. This is an area in which Venable has a very deep and extensive practice, not only in counseling nonprofits in how to comply with the federal and state tax laws that regulate their activity, but also what we call our nonprofit tax controversy practice, having represented over at least 150 different tax-exempt organizations in connection with IRS audits and appeals, quite a number of recent and ongoing U.S. tax court cases, and a lot of other work that is really going to inform the discussion that you're going to hear today. All of that experience has really opened our eyes quite significantly to how the IRS enforces this area of the tax code, what they really care about, sometimes what they don't, and how you can be successful in protecting your organizations with respect to these issues. Today we're going to focus on an IRS report that came out fairly recently involving what's called a compliance project. Matt's going to talk to you about what an IRS compliance project is, but this compliance project focused on a particular segment of nonprofits, tax-exempt colleges and universities. The IRS released an interim report, and then in the end they released a final report. And while there certainly are some issues that are fairly unique to colleges and universities, and we recognize that most of the participants in today's program and most of our programs do not come from colleges and universities, this is a report that has, as our title suggests, very important widespread implications for every tax-exempt organization. And we're going to be focusing today on all of the various aspects of this report that have implications for all exempt organizations, and hopefully will help impart to you some things that you can take away to take back to your own organizations, to kind of take a look under the hood in terms of your federal tax compliance and look at things that you might want to tweak or do differently or change organizationally or operationally to try to put yourself in a stronger position. A few housekeeping notes. First, a preview of a couple of our upcoming programs. Next month, another program that's likely of great interest to all of you attending today. Donor intent, restricted funds, and gift acceptance policies, what every nonprofit needs to know to effectively accept and utilize contributions. That's a program that we're going to be partnering with the BDO accounting firm. Dick Larkin from that firm is going to be participating along with some of my colleagues in what I expect to be a really popular and interesting program. And then on December 5th, our program is entitled Work and Family, What Nonprofit Employers Should Know About Family-Oriented Employment Laws. This is another very hot area, an area that's very complex, very much changing quite a bit, and an area where we constantly get questions from our clients, and I think it'll be a program that you'll all enjoy if you can participate. In terms of questions today, we will take questions throughout the program, so for those of you in the room, if you have questions, raise your hand. Kelly will be in the back of the room with a handheld microphone. She'll come around and bring that to you so that the folks on the webinar can hear your questions, so just wait a second for the microphone to get there. We'll also, of course, leave time at the end if you want to save your questions for later. And those of you on the webinar, pose your questions to me via the chat feature, and I'll monitor the laptop in the front of the room and pose those questions to our speakers at the appropriate times, or sometimes answer them directly. In terms of handout materials, apologize for the number of trees we had to kill today to create these handout books. There are some For those of you in the room, you have a bound handout book that has not only the PowerPoint presentation, but quite a few articles that we've written, of which my colleague Matt Journey was the principal author of all or most of those, on all related topics to the things we're going to be talking about today. There's some really valuable articles in the handout materials there that I'd encourage you to take a look at. For those of you on the webinar, you will receive an email tomorrow, all of you will, that contains a link to the recording and streaming PowerPoint presentation from today's event, along with all of the handout materials. Feel free to forward that on to colleagues and others who might benefit from that. Finally, on the last page of the PowerPoint presentation, you'll see links that we have to all of the resources that Venable has on various nonprofit legal topics, our articles and PowerPoint presentations, recorded webinars, all of which are recorded, including today's, that you can find and are all searchable by topic area as well. Now, turning to our program today, our two speakers, to my far right is Matt Journey. Matt is an associate in our nonprofit group and has truly become our nonprofit tax guru, has really helped to take our nonprofit tax controversy practice to a whole new level. In fact, in some ways really helped to put it on the map in a much more material way. Matt's a key part of our team, has been intimately involved in every major IRS audit and appeal and tax court case that we've been involved with in nonprofits for the last, 5 years you've been here? 4 or 5 years? 6 years. Okay, time flies. Matt's an absolute pleasure to work with. One of the most modest guys you'll ever meet. Oh, no, sorry, that's not Matt, as you'll hear. He's a wonderful guy, very talented, very aggressive, loves to battle the IRS, and you're going to learn a lot from him today. And to my immediate right is Meg Rolfing. Meg is a first-year associate in our group. I think this is the first time we've ever had a first-year associate participate in one of these programs, and it's the first time Meg's doing it. Meg has worked closely with Matt and myself and others in a number of our nonprofit tax matters, is a really bright young lawyer, a quick study, has delved in and really, she was a key player in helping us to write a pretty extensive article and alert that we put out on this topic, which is in your handout materials, by the way. And so Meg's going to be contributing to the discussion here today. And with that, I'll turn it over to Matt to get us started. Matt?
Well, I came in, I had a plan of sort of what I was going to talk about. And then, as Jeff mentioned, we have these handouts here for the people listening on the phone. It looks like about 100, 125 pages. And since Jeff said that most of these are comprised of articles I wrote, and since I'm the only nonprofit tax authority that I recognize, I figure I'll just read all of this instead of going through the presentation because it'll be much more useful to you. And if you're worried about time, don't worry. I've been here for just less than 6.5 years, but it flew by. Jeff only thinks it's been 5, so it's pretty much going to just go by. But it's sort of an interesting presentation today because 2 weeks ago I gave a presentation where I talked about how IRS enforcement with respect to exempt organizations is something that's going to probably fall by the wayside for the most part for the next few years after the 501c4 issue and the political activities, especially with a number of the people, the executives in the exempt organization branch, retiring of their own decision or not. So enforcement is really something that's probably going to be less of an issue and focus for exempt organizations. The purpose of this presentation is to explain why enforcement is an issue. So it's sort of interesting because while enforcement is probably going to be less of a focus for the IRS in the next few years, enforcement for certain issues that are sort of on the forefront of the IRS's mind and something that they've got momentum on is probably something that's going to be continue. And to the extent that there is enforcement, it's probably going to be with respect to these issues. That's why I sort of have IRS enforcement at the top. I don't have any slides for IRS enforcement, but that really is what this comes down to. Enforcement is probably the most important part of tax law because this is where the tax laws are applied. And this is why it's important not just for colleges and universities, but this is an important topic for all organizations. The purpose of the presentation is to focus on how the IRS is enforcing through these new compliance projects, what the type of enforcement is, what it looks like, and then also what are the issues that are of focus. And this is important because it allows you to prepare and be ready for the way that the IRS will look to identify issues with your organizations, and also it'll prepare you for the issues that you need to be wary of as you move forward. As I said, enforcement is going to be sort of at a new low, but the issues that are being enforced will be the issues that we're going to talk about today. And so just an example of sort of how the enforcement ebbs and flows and why it's important to understand enforcement as opposed to just the law. The law is pretty much unchanging. There are changes here and there. In 96 there was a big change we'll talk about, 4958. But for the most part, exempt organizations now are what exempt organizations were many, many years ago. But the IRS's focus on these issues changes all the time. An example, there are going to be a couple examples in this presentation, but one of the examples is net operating losses, something that Meg is going to talk about. In the late 80s, this was an issue that the IRS was very concerned about, the use of net operating losses to offset unrelated business income. In fact, there was a case that went all the way to the Supreme Court in 1990. And after that case went to the Supreme Court, the IRS sort of said, we won this issue and stopped looking at it altogether. And it was something that I had not really thought much about advising my clients on even until this report came out. And the report has a substantial focus that Meg's going to talk about. So it's important to understand that the law is what the law is. And as an attorney that advises at least some of the organizations in this room or down listening to the phone call, I got to tell you, you must follow the law. But the focus with what you follow the law should be done with an eye towards enforcement and how the IRS is looking at the law, both in interpretations of that law and in the amount of effort you put to making sure that you are as perfect as possible with respect to certain aspects. So this brings us to the compliance project process. The compliance project process is basically, I'm changing it on the compliance project process is sort of a new way that the IRS conducts examinations and reviews exempt organizations. It's actually a really good idea, and it allows the IRS to look at an entire industry or one issue amongst several organizations at one time. And doing so allows the IRS to develop a substantial amount of knowledge and information and more efficiently use its resources. What the IRS does is they will identify issues that are specific to that industry because colleges and universities are very different from country clubs. And so if you develop an examination template for all exempt organizations and you're trying to apply it to large industry organizations, and you're trying to apply it to country clubs, and you're trying to apply it to hospitals, and you're trying to apply it to blood banks, you're going to have a problem doing that because one size doesn't fit all with those organizations. Those organizations each present very different types of issues. And so what the IRS does with compliance checks is they say, we're not going to develop a one exam template for everything. We're going to look at all of the hospitals at once, or at least as many as we can. And we're going to develop an examination template for hospitals. And then we're going to use the information that we develop to go out and actually look at the hospitals and examine the hospitals according to this template. And in addition to that, the IRS also does a substantial amount of training with respect to the issues it identifies. So if you're under a compliance check and you end up in an examination, the IRS agent that shows up at your office is going to be an IRS agent who has been taught a lot. I don't know if they know it, but they've been taught a lot or told a lot about the very issues that they're going to try to develop with your organization. Compliance projects can focus on either a single industry or a single issue. We saw this single industry with hospitals, credit counseling organizations, and with respect to the one we're talking about now, colleges and universities. It also looks, the IRS also looks at single issues. The IRS looked at a lot of self-certification organizations that are exempt under sections of code other than 501c3 can self-certify their exempt status rather than applying for exempt status. The IRS decided that they were going to look at self-certifiers and decide whether or not the organization self-certified because they were not doing things properly and just wanted to avoid the tax, or if there were other reasons for it, and they wanted to sort of understand the motivations for self-certification. We also saw it recently with political intervention and the activities there. There's sort of a mini project with respect to the Determinations Division. And also officer compensation has been one that the IRS has focused on. There are several advantages and disadvantages to compliance projects in this system of conducting examination. And to some extent, the advantages and disadvantages depend on whether you are the IRS or the industry. But there are some advantages for industry as well. First of all, one of the advantages, and this can also be a disadvantage, is that the IRS develops a pretty substantial understanding of the industry as a whole. They understand unique issues with respect to that industry, and they understand where, when going out there, where their guidance has been deficient with respect to advising certain organizations and types of organizations how to comport themselves with the law. This isn't good because if you are generally an organization that's trying to do the right thing, or the representative organization is trying to do the right thing, and you are taking every step to comply with the best practices of your industry, even if the IRS decides that maybe your industry needs to refine its best practices, when the agent comes out there, the agent is not going to say, you are the one bad actor in this industry. They're going to come out and they're going to understand, and they're going to compare you to the industry so that if there's a situation where the industry is deficient in some way, you're not going to be compared to what the IRS wants necessarily, but to what the IRS sees as the other deficiencies that the industry presents. That being said, that's not going to be a get-out-of-jail-free card because there are situations where the IRS comes out and decides that an industry is itself full of bad actors, and in those situations, the IRS will predetermine pretty much every examination. We saw that with the Credit Counseling Compliance Project, where the IRS decided that credit counseling organizations were bad organizations, and based on their overall industry review. So when the IRS went out to any individual organization to do an examination, the presumption was that would result in revocation. In fact, the IRS had several layers of review of any recommendation other than revocation. So that's an advantage and a disadvantage. Another advantage is that the IRS will often, as part of these projects, publish guidance. The IRS doesn't publish a whole lot of guidance anymore. They're private letter rulings. They're the annual revenue procedures. But the IRS has tried to avoid publishing too much guidance. But with the compliance projects, this is something that becomes very important. The IRS becomes very familiar with the industry, and they say we need information regarding issue X, Y, or Z, and you'll start to see information with respect to those. There are several common phases of the compliance project. One of the reasons this is such a good program is because you have systematically set up a way to review these organizations. First, you have the phase one, where you conduct the initial review and the research on the industry. You develop a questionnaire that can be sent out to the organizations, and then you have the examination phase. With respect to the first phase, the review, the IRS will try to learn as much about the industry as possible. The IRS looks at many sources. The IRS will look at Forms 990 for a substantial part of the industry. There are a lot of clients I have that say, well, who looks at the Form 990 anyways? Let's just get it done. The IRS looks at the form. And it's important that the Forms 990 are not just completed expediently, but completed in a way that thoroughly demonstrates your exempt status and the worthiness of your exempt status. Another issue is, another way they obtain information is the media. A lot of IRS examinations start from the media, and a lot of compliance projects start from the media. We represented several organizations involved in a recent compliance project, and we did a FOIA request looking at the information that the IRS used to sort of establish its understanding of the industry. And what we saw was the Wall Street Journal, the Washington Post, USA Today. There was article after article after article. And the important thing to understand with this is that very rarely does the media write an article that results in a compliance project where the article is, this industry and this organization is such a great organization and doing such good things. The media reports often are fairly damning, whether they're looking at a single organization or the industry at large. But it's something to keep in mind that when you're looking at sort of your role in the industry and sort of where the industry is heading, keep an eye on what's being written about you and about your industry, because that's going to be a source of a lot of IRS information if there is a compliance project. Based on the information that's reviewed, the IRS will develop a questionnaire and identify organizations to obtain information from. They'll identify the parameters of the industry that they are going to look at, whether it is all hospitals, whether it is hospitals that only present a certain issue, or whether it's certain departments in hospitals. And then they will also look at the size of the project. They do a lot of mathematical sampling and research to try to figure out how to get the appropriate sample size to get a feel for compliance within the industry as a whole. And then they will start identifying specific organizations that will be the subject of the project. In addition to this, what's interesting is that when the IRS sends out the questionnaires and receives them back, unlike an examination where you have an agent that's looking at one organization and doesn't have sort of a context, the agent is, as I say, looking at the tree. Here the IRS is looking at the entire forest. So the IRS will get all of the information in at once and be able to start to sort this information and look at this as a single sort of unit. And you're able to identify pretty easily where the outliers are. If you have expectations with respect to a certain issue, you're able to see 80% of this industry fails to comply with this issue. And the IRS will start to develop sort of an examination plan around that. Phase 2 is the actual sending out of the questionnaire. And the questionnaire, the depth of the questionnaire really depends from industry to industry. For colleges and universities, those are huge organizations with a wide expanse of activities that they engage in. The compliance questionnaire was 30 pages, and I didn't prepare any compliance project responses for those, but I assume that the responses often would number in the hundreds or more pages. But for the self-certification compliance project, a very issue-specific project, it was only a 9-page questionnaire. So the depth that the IRS is looking at these issues often depends on the industry itself. Another interesting thing about this is based on this, the questionnaires that they get, the IRS will develop its standard information request for examinations. The IRS will also, once identifying issues with the industry, start to train agents with how to identify these issues and how to develop the facts necessary to, whether it's an issue that results in revocation or unrelated business income tax, how to develop sufficient facts to be able to sustain that position both in appeals and then eventually, if necessary, in litigation. So the IRS really focuses on this in the information that's provided. I covered a lot of this. A couple important considerations with respect to the questionnaires. First, this is not an examination. If you receive a compliance check questionnaire in the mail, that does not mean that you are examined, and it may not mean that you will ever be examined as part of this project. The compliance check questionnaire, no matter what you put in it, cannot result itself in revocation of your exempt status, any assessment of taxes for unrelated business income tax purposes, or change in your foundation status. Also, organizations are not legally required to fill out or return the compliance check questionnaire. So if you decide that you really don't want to complete the questionnaire, you are not legally required to do so. However, I strongly recommend that anyone in this room who receives or on the phone who receives the questionnaire completes it, because as we'll talk about in a few minutes with the College and University Compliance Project, of the 400 or so universities that received questionnaires, 13 did not complete the questionnaire. All 13 resulted in examinations. The total number of examinations was about 8.5% of the organizations. So you had a very small chance of being examined if you completed the questionnaire, but you had a 1-to-1 chance of being examined if you received and did not complete it. So not required by law, but I strongly recommend that you complete them. The question that I'm asked most frequently is, when talking about questionnaires, is who gets examined. And when an organization receives a questionnaire, before they fill it out, they call me and they say, does this mean I'm going to get examined? And the answer is I don't know. It varies widely who gets examined from one compliance project to the next. The IRS will decide who gets examined based on a review of the information. For the for credit counseling organizations, about 80% of the industry was examined, in part because the IRS Commissioner at the time, Everson, testified before Congress that they were examining virtually the entire industry. So they had to have a lot. But they decided there was a lot of noncompliance, so they wanted to look at as many organizations as possible. For the hospitals, there were about 20%. And then, as I said before, about 8.5% of the industry was examined for colleges and universities. Examinations. The examination stage is the stage where the IRS actually shows up at your offices and gives you a list of information that they want you to provide them. And the examination stage is where an organization may be revoked, an organization may have to have a tax assessed against them, or their foundation status may be changed. Examinations are, I'm willing to bet that for everyone that's participating in this call, except for possibly me, examinations are not fun. I think that they're a blast, but I'm in a different position than organizations that are being examined, so I understand if most of my clients don't share that opinion.
Yeah, Matt has a very rare disease, and he actually literally enjoys this. And the harder the challenge, the greater the challenge, the more fun he gets out of it, especially when he prevails. And Matt, just as an aside, why don't you share your current track record vis-a-vis the IRS and nonprofit tax cases?
Sure, and I want to correct something. Jeff said when I prevail. I don't lose. I've not lost, so I don't plan to lose. So we'll just say I prevail. And I'll let the record speak for itself. But when the IRS shows up at your office, this is, it's not fun. We do have I actually have a couple clients who liked the agent that examined them, and they enjoyed talking with the agent and actually hang out with the agent socially after the examination is over. Unlikely happen during the examination for lots of reasons, but that's one client. So by some, I mean one.
Yeah, I've never seen that happen in any other case, by the way.
Yeah, so it's a rarity. For the most part, the clients are not having much fun. The examinations cost a lot of money, both in legal representation or having your accountant represent you. And they take a lot of time in that you've got to provide the IRS with a substantial amount of information. You will end up providing, if you're doing a thorough job providing information, depending on the examination, you can provide hundreds and hundreds of boxes of information to the IRS about your activities. You'll also have to deal with interviews and just the general stress of having sort of Damocles sword hanging over your head with the IRS out there all the time. And even for a very good organization that's doing its best to comply with everything, the tax laws are complicated. And if there is an agent that's out there with a very specific purpose and sort of has a axe to grind, then this can be a very stressful time, even if you are a very compliant organization. The last thing is that these examinations can take a long time. The quickest examinations when the IRS is out there can take 2 or 3 months. We have had examinations or clients where we represent and worked with where the examination lasted a decade or longer. And a decade of sort of being in this sort of a limbo state where you're not sure what the IRS is going to do or how the IRS is going to come out on something is very stressful for the organization. And depending on the industry you're in and how competitive it is, with respect to donors, other organizations in your industry may know you're under examination and start to, in competing for the smaller amount of donor or the share of the market that you're in, may start to let other people know that you're under examination, that you've been under examination for a long time. And while you don't know the results, it's obviously there must be something. You've been under examination for 7 years now. And so even for good organizations, there's a lot of stress that's involved with this. So the best option is to do a good enough job preparing the compliance check questionnaire as thoroughly as possible to demonstrate that you should be an exempt organization and should not be examined. With that, I'll hand it over to Meg.
Thank you, Matt. So now we're going to turn to talking about the Colleges and Universities Compliance Project more specifically. The Colleges and Universities Project followed the same phases that Matt's just finished going over. In October 2008, the IRS began work on the project by distributing an initial compliance questionnaire to over 400 tax-exempt colleges and universities, which is about 16% of the entire community. In May 2010, the IRS released their interim report on the project, which is based solely on responses to the questionnaires. And at that time, the IRS announced it had selected 34 colleges and universities for further examination, based in particular on these two areas that Matt and I are going to talk more about, unrelated business income and compensation. As Matt said, that was about 8.5% of the number of schools that received the initial compliance questionnaire, but 100% of the ones that did not complete the questionnaire. The schools the IRS chose included both public and private schools, and about 2/3 of the colleges and universities examined were considered large schools, which would be schools with over 15,000 students. Then on April 25th of this year, the IRS released its report on the project and announced it had concluded 90% of those examinations. The final report summarizes the findings of about 5 years of research and analysis by the IRS on this industry, and the report discusses conclusions based on information drawn from the compliance questionnaires, Forms 990 and 990T filed in the periods under examination, and other information from the on-site examinations. It also contains a lengthy explanation of the IRS's methodology in compiling the report, if that's of interest. The report describes common areas of noncompliance, in particular unrelated business income and compensation. It doesn't give any details about specific schools or specific results of examinations, but provides an analysis of general patterns that the IRS saw in conducting this compliance project. So some of the major findings in the report come in the area of unrelated business income, or UBI. And before we discuss those, I'm just going to go briefly over the sort of basics of UBI as a refresher. So in general, tax-exempt organizations are not required to pay federal income tax on income derived from activities that are substantially related to their exempt purposes. But an exempt organization can be subject to income tax on income derived from unrelated trade or business activities. And this is known as the unrelated business income tax, or UBIT. To determine whether income from a particular activity is subject to UBIT, the first step is to characterize it as an unrelated trade or business. So an unrelated trade or business is any activity that meets the 3 prongs that I'm about to go into. The activity must, of course, be a trade or business. The trade or business needs to be regularly carried on, and the trade or business must not be substantially related to the purposes for which the organization was recognized as exempt from income tax. To break those concepts down a little bit further, to be a trade or business, the activity must be carried on for the production of income or for the sale of goods or performance of services. Activities don't lose their identity as a trade or business just because they might be conducted as part of similar activities that are related to the organization's exempt purpose. And in determining whether something is regularly carried on or not, the IRS often looks at how that activity is carried on how similar activities are carried on by non-exempt organizations. And finally, for the activity to be substantially related to an organization's exempt purposes, it has to contribute significantly to the accomplishment of one or more exempt purposes. Just generating money to be used to pursue exempt activities isn't enough to characterize an activity as substantially related. So UBI is a common issue for all types of exempt organizations. And I just wanted to go into a couple of examples to try and flesh that out a little bit. So to start with a more large-scale example, we can use something from the colleges and universities context, sports camps. A lot of colleges have sports camps in the summer, and my undergrad school, Duke University, has a really big one for basketball. It's for members of the public, not for students, and you can pay thousands of dollars to stay in the dorms and eat the awesome food and hang out with Coach K, which is like a magical experience, and you would obviously pay any amount for that. I'm not biased at all. So I don't know how Duke actually sets it up, but for this example, let's say Coach K runs the camp from his own for-profit corporation, and he contracts with Duke to rent out Cameron Indoor, the basketball stadium, to rent out the dorms, the dining facilities, for food, beverages, also for a lot of additional staff that he's going to need to help him run the camp. All of that income to Duke raises a UBI issue because it's not related to Duke's exempt purposes of educating students. Again, the attendees at the camp are people who have disposable income to go attend a basketball camp worth thousands of dollars. So they're not college students or close in age to college students probably. But not every organization, of course, has a Coach K or a basketball camp or even a golf course like colleges and universities might. UBI can come up in a lot of seemingly like more mundane situations. And determining what is and is not UBI really gets very fact intensive. So a couple of other examples, it can come down to differentiating between items in a museum gift shop. So if you go to a museum gift shop like the National Portrait Gallery across the street or another museum around here in DC, you can find that they sell cards or reproductions of famous artworks that are displayed. Selling those cards or reproductions is related to the organization's exempt purposes because it helps educate the public about art generally, and that's the museum's mission. But sales of souvenir items like I Love DC t-shirts and mugs, or those FBI sweatshirts that I guess some people buy, that is not related to the organization's exempt purpose and would generate UBI. Go ahead, Jeff.
No, keep going. I was going to offer one interesting example to show how you can sometimes take an unrelated activity, in this case an unrelated item, and turn it into a related activity. So Meg is right that generally when a museum gift shop is selling reproductions of its exhibits or its artwork or things like that, on postcards and little statues and things like that, that's in furtherance of its exempt purpose because it's getting that mission, that word out there about the types of exhibits that it has in its facility. And generally just having the logo of the name of the museum on a coffee mug or a t-shirt does not substantially further the organization's exempt purposes. But there was an IRS, I believe it was a private letter ruling back from probably close to 20 years ago, where there was a 501c3 nonprofit whose mission was to protect endangered species. And it was selling logo items, like the kind of things we're talking about, but it came up with a creative idea for how to turn what was going to be otherwise unrelated business income into a related activity. And what they did is on each logo item, it was all a series of desk accessories, they would imprint a picture of an endangered species along with the logo of the organization and accompany it with a little piece of literature, a card that had details about that endangered species and giving specifics about it and talking what you, a member of the public, could do to help protect that endangered species. And the IRS ruled that did turn that into a related activity. So it's just an aside, but it's an important aside because in these issues you need to think creatively about how you can do that. And then one more kind of planning technique. When you have these kind of logo items, sometimes it's just impossible to do what we're suggesting. It's impossible to turn it into a related activity. But it is possible to outsource that activity. So say you hire some company that wants to produce T-shirts and coffee mugs and sell them to the public, to your members, supporters, others. You can do that. You license your logo to them. You let them produce, market, and sell those products, and then they can give you a percentage of the sales as a royalty. If you do that and your role is very passive, they're doing the marketing and the selling, and you're just sitting back and licensing your IP to them, intellectual property, and collecting the royalty on a percentage of the gross sales, that is all tax-free income under the royalty exception to unrelated business income. So while none of this is directly relevant to today's presentation, it is important stuff and hopefully gives you some ideas for planning.
Yeah, and the examples we've been talking about so far have been about whether or not the activity is related to the exempt purpose, but I think it's also important to think about the regular carried on element. An example of that would be a veterans organization that sells Christmas cards. You might think that that's not regularly carried on. It only happens during the holiday season, which apparently starts in like August these days. But again, it's a specific time of year. But the IRS did find that sale of Christmas cards did generate unrelated business income for that organization because they were conducting those activities at the same time that commercial card sellers sell Christmas cards in the same time frame. And finally, the last example is something that organizations, all types of organizations, deal with often, which is income from advertising in magazines and publications. And again, determining what is taxable advertising income versus what qualifies under one of the exceptions to UBI, qualified sponsorship payments, can be really fact-intensive and can come down to wording, visuals, and a lot of other specific details.
If you guys want more information on this topic, we did one of these monthly programs about a year and a half ago. You might have listened to it to get ready for this. Some of my colleagues and myself did on royalties and licensing and corporate sponsorships and advertising. Like I said earlier, all of those recordings are posted on our website. You can find that link at the end of the PowerPoint presentation today, but it does delve into those issues in a lot of detail.
So if an organization does end up generating at least $1,000 of gross unrelated business income, they have to file the Form 990T, which gets filed annually with the Form 990 or a variant of the Form 990. And when completing the Form 990T and reporting unrelated business income, the tax code does allow an organization to take a number of deductions. The code permits deductions for net operating losses that are connected to carrying on unrelated trade or business. And a net operating loss, or an NOL, that is a loss that is reported in 1 year and used to offset gains in past or future years. Colleges and universities and a lot of other exempt organizations often report net operating losses from unrelated business activities and then use those to try to offset general UBIT liability. For example, as Matt touched on earlier, net operating losses were a popular issue with the IRS in the 1980s and 1990s, especially in the context of C7 organizations like golf clubs. And having the course and the clubhouse and its restaurant at a golf club open to members of the public, non-members, meant generating unrelated business income. And sales of food and drink to those non-members was usually not enough to recover the cost of making those sales, which means the activity ultimately generates a loss, and that would lead to a net operating loss for the organization. But as we'll get into a little bit later, if the activity generates a loss year after year, it can pose a problem for the organization. Organizations can also take deductions for expenses that are directly connected to the unrelated trade or business, and that also became a focus in the final report for the colleges and universities project. So as we've been discussing, UBI is a complicated area of tax law to navigate, and the colleges and university report findings show us just how problematic it became for some of the schools that were examined. One of the big findings coming out of this report was that 90% of the schools examined had misrepresented UBI on their Forms 990 and 990T during the years of examination. The IRS found that adjustments to UBIT liability often arose in connection with the same types of activities, including advertising, we've just been talking about, arena use, facility rentals, operating fitness and rec centers, sports camps, and golf courses. Nearly half of the colleges and universities examined incurred changes to their UBIT liability because of advertising and facility rentals. And about a third incurred changes to their UBIT liability due to operation of fitness and recreation centers, sports camps, and golf courses. In terms of reporting, the IRS also made a number of important findings, particularly related to losses and expenses. On 60% of the Forms 990T that it examined, the IRS determined that losses used to offset unrelated business income were not sufficiently related to those business activities. The IRS reported over $170 million in disallowed claims of losses and more than $150 million in net operating losses disallowed specifically. The key reason behind those loss disallowances was really that the examining agents, when they got to the institutions, failed to find that there was that required connection between the trade or business and the activities that generated the losses. In particular, the IRS identified a lot of instances in which examined colleges and universities had reported net losses for activities for which expenses had consistently exceeded unrelated business income for many years. The IRS determined that some of these activities were not carried on with the profit motive that characterizes a trade or business, and disallowed the losses that flowed from those activities. In the past, the IRS has looked at more factors than whether or not an activity has a history of losses in determining whether or not it's been carried on with a profit motive. But in this report, the IRS was particularly focused on that history of losses. A record of losses year after year is now probably something the IRS is likely to consider problematic and as evidence of a lack of a profit motive, which could ultimately lead to disallowing the losses that flow from that activity. Some other common findings among the examined colleges and universities included simple accounting errors in computing net operating losses and problems in substantiating the amounts of those losses when asked by the agent. Finally, in about 40% of the institutions examined, the IRS found that they had misclassified activities as exempt and not reportable, and this led to the IRS reclassifying about $4 million as UBI and subject to tax. And with that, I will turn it back to Matt for the compensation element of the report.
Before Matt jumps back in, we did have one question for you, Meg, from one of our webinar participants. He wants to know if you can spell Coach K's last name.
This is so embarrassing, but I can't. I'm sorry.
That's all right. I can't either. Don't worry. That's why he's known as Coach K. Hey, Matt.
It's been a while since I was in college, guys. Come on.
What was generally the answer on the sports camp?
Craig, your question is what was the answer on the sports camps in terms of how the income should be properly classified?
Well, I mean, there aren't any specific details in the report, so I can't speak directly to the results of a specific examination of a sports camp. But again, whether or not the income from the camp is UBI definitely comes down to specific facts of the camp. If it's a camp that's geared, I believe this is right, but if it's a camp that a college is conducting that's geared toward, teaching disadvantaged youth tennis, then that sort of thing you can demonstrate as being related to the exempt purposes.
Yeah, I think that's a great example. All these UBI determinations are very fact-specific. What's UBI to one organization may be, what's unrelated to one organization may be related to the organization right next door. And like I said, I gave in my example earlier, how you structure the program very much factors into the analysis. So if this is just simply, and look, almost all the big college basketball coaches do this, and in other sports too, where they hold camps every summer. These are not focused on generally on disadvantaged youth. There's generally not scholarships available. This is simply a way for the coaches to, to make money, increase their visibility and exposure in the community, and give kids a good opportunity to learn from those coaches. The coaches. I think my son did one of these. I think at University of Maryland, and I think Gary Williams showed up for like 1 hour of the camp or something like that. But anyway, the point is how you structure it, who's eligible to attend, what are you focusing on and stressing. But if it's simply a way to do what I just described, it's probably going to be an unrelated activity. And it sounds like that's what the IRS concluded on a larger scale.
Yeah, and to answer our webinar question, Krzyzewski is spelled K-R-Z-Y-Z-E-W-S-K-I, and everybody in the room can confirm that I did not look that up on my phone.
All right, Matt.
All right, Matt.
Just one more add-on to that question and to Meg's sort of discussion of the sports camps. I believe that if the sports camp were focused entirely on training kids to yell, jump up and down, and generally be annoying in Cameron Indoor Stadium, then it would be part of the exempt function at Duke, because I believe that's Duke's sole purpose. And Meg can correct me if I'm wrong, but I think that's it.
By annoying, you mean charming, and most devoted fans in college basketball, then you're correct.
That may have been implied. One of the other big issues that was really the focus of the compliance project was compensation. And sort of giving you background on compensation issues with the IRS, there are two types of issues that the IRS can raise with compensation. Issues that are enforced against the organization itself, which would include private inurement, private benefit, and issues where an excise tax is levied against the individual who receives the excessive amount of a benefit. With respect to the organizations, we have, I said, private benefit, private inurement. Private benefit is generally applied to all organizations, and it's where the organization is operated for the benefit of private individuals rather than the public or the group that the organization is supposed to benefit. And an example of private benefit, not all benefits are impermissible. So if your organization hires an independent consultant to do data processing or implement a software program that you use in providing your exempt function, that's permissible at a reasonable amount, to pay at a reasonable rate. If your organization hires that same independent contractor to engage in all of your organization's activities, and that independent contractor is paid at a rate of 100% of the net revenue of the organization, not a stated rate, then that would be an impermissible private benefit, where the operations of the organization are conducted solely for the benefit of the individual that's being benefited. A couple things about private benefit is a benefit that can be to anyone. Inurement, which I'll talk about in a minute, is only applicable to benefits provided to insiders, but a private benefit can be something that is given to anyone, and so just because you don't have a specific relationship on paper with an individual, if your operations benefit that person substantially, you run the risk of a private benefit. Private inurement is very similar to private benefit, but it is a situation where the operations of the organization are conducted in a manner so that the organization's assets inure to the benefit of a disqualified person. And the inurement principle is to protect the public from having organizations that work solely for the benefit of the founders of the organization or for the founding families or situations like that, where you have excessive compensation to an individual. An individual who runs the organization also owns the largest contractor of the organization and gets sort of sweetheart deals in that way. For penalties against individuals, in 1996, the IRS, Congress added 4958 to the code, which is generally known as intermediate sanctions. Prior to 1996, if there was inurement in a situation, the only enforcement tool that the IRS had was revocation. So if this was a situation where one individual sort of became CEO and then just took the organization over, received excessive amounts by sort of coercing the board, the IRS comes in and the individual gets fired, the only tool that the IRS has at that point is to revoke the organization who has corrected the problem of firing the individual. 4958 is sort of seen as a way to address that. That's why it's an intermediate sanction. What it does is it imposes an excise tax on individuals who receive excessive benefits from an organization. An excessive benefit is any benefit that where consideration is greater than fair market value, or the amount that an asset is either purchased from or sold to an organization is at less than or greater than fair market value, depending on the purchase or sale. And so this is a way for the IRS to go after individuals rather than focus on organizations and harm organizations where the individual was really the culprit. It can be imposed on disqualified persons, which are generally officers, directors, key employees, and others who are individuals who influence an organization's outcome or activities, such as founders. Any individual that is sort of in charge of a substantial part of the organization's overall activities would also be subject to it. And the penalties are where this gets very onerous. And the penalties on the individual are, first, there's a 25% excise tax on the excessive amount of the benefit. In addition to that, the individual who receives the benefit is required to return the excessive amount of the benefit. And if that person does not return the benefit prior to the assessment of the tax, the IRS gets to assess an additional 200% excise tax on that individual. So as an example, if an individual receives $100 in compensation and the IRS says 60 was reasonable, then the excess amount is $40. The first level tax is 25%, so the person has to pay $10 to the IRS and then is required to return the $40 to the organization. If the person doesn't return that organization, or if the person does that, they're paying $50 in tax basically on $100 income, in addition to income taxes, because that's not, you don't get to deduct the payments for 4958 from income taxes. And then if they don't return it, they get the additional 200% penalty, which would be 200% of the excess amount, which would be $80. So they would end up paying $90 to the IRS in addition to income taxes, on a $100 payment. And that is important for everyone in this room, because if you are an individual that reviews the activities of an organization, you don't raise this, and they have to pay $90 on $100 in income, you're not going to be advising them anymore. And if you are a person that has to pay $90 on $100 of income, you are not going to be a happy person. So people need to pay attention to this part. In addition to the individual, organization managers, such as directors or other officers that approve the transaction, can also be assessed an excise tax of 10% of the excess amount of value. But the news isn't all bad. There are ways to protect yourselves in your organizations, and the IRS has, or the regulations provide a rebuttable presumption of reasonableness, which is basically a safe harbor, where if you complete certain steps in approving the compensation, you will protect your organization and yourself from having the inference that it is an excessive amount of compensation. It will be presumed to be reasonable. The IRS can rebut it, but in every situation I've seen an organization properly assert the rebuttable presumption, the IRS has made no effort to rebut it. So it's, while not entirely bulletproof, it's a pretty good start. And in order to assert the rebuttable presumption of reasonableness, prior to paying any amount under the transaction, the organization must have an independent body. So if your board of directors includes the individual who may be getting paid, they have to recuse themselves. They can't participate in the discussion or the vote at all. Review and determine the amount of compensation for the transaction that's reasonable. The independent body must rely on comparable data in setting the compensation amount. And finally, the body must document its decision in writing contemporaneously. And contemporaneous means any time before the end of the year that the transaction was approved. We've got a question in the back. Well, side back.
Yeah. If an organization meets the reasonable test, is this just limited to the IRS accepting it as reasonable, or do other federal agencies have to accept this as being reasonable? I'm specifically referencing the Office of Independent Advisor.
Yeah, so the question is if, and going forward, for those of you who have questions, just wait till the microphone gets to you. If an organization establishes the rebuttable presumption of reasonableness, obviously that applies vis-a-vis the IRS. Does it also apply with respect to other federal agencies that may be looking at the reasonableness of a particular transaction? And the answer is, at least from a legal perspective, no. That's not to say that other agencies might not take that into account and ascribe some merit to it. It certainly could. Same thing could apply to a state attorney general who's looking at a nonprofit that's incorporated in its state for purposes of the fairness or reasonableness of a particular transaction. Certainly, it's relevant. But it's not binding. Remember, this is a rebuttable presumption, and we've seen, and Matt and I have been involved in cases where the organization did go through these steps to establish a rebuttable presumption, but then the IRS challenged it nonetheless. One case that actually we could not convince the IRS otherwise, even though we had a very strong case. Matt and I convinced the client to file suit in U.S. tax court last year, and after some very effective early rounds of litigation, the IRS came back to us and offered to settle the case. They were seeking how many millions of dollars?
About $2, but I wanted one correction there to what Jeff said. This actually shows the importance of the rebuttable presumption. Prior to entering into the transaction, the organization did not assert the rebuttable presumption. So they entered into the transaction. They paid the amount. They went on their way, and 2.5 years later, just before the statutory period of limitations closed, the IRS shows up and says we want to look at this transaction. And when that happened, the organization started to get nervous. So the first thing they did was they said, well, we think we paid a reasonable amount. They weren't trying to enrich an individual. But they wanted to be sure, so they went out and they hired a reputable consultant, independent, not even in the same state that they were in. They had no connection with them. The consultant came in and said that the amount that was paid for this, basically an officer sold a business to the nonprofit organization, said that the amount that you sold your business for was actually about $100,000 less than fair market value. So the organization breathed a sigh of relief. However, the IRS took the position that because they did not establish the rebuttal presumption prior to entering into the contract and transaction, that the presumptive value of the transaction of the business that was sold was actually $0. So rather than look at or pay attention to or even consider the report of an expert, I think the expert had like a PhD from MIT and the other one had a PhD from like Stanford. So they were both smart people, much smarter than me. And there's not many people like that, so that's important. But rather than pay attention to that at all, the IRS said this entire amount is excessive and we're going to tax you on the entire amount. And based on that, they did, the 25% tax, and the organization, the individual believed that they were in the right, and they didn't want to return it, so they kept pushing it up the ladder, and then the IRS assessed the 200% amount, and we ended up going to court on this. And this shows why it's important to set up the rebuttal presumption, because the IRS conceded the case fully, and the individual had to pay no taxes at all. However, it was a very expensive process to get there, and paying the amount to have an expert come out beforehand and do it once before entering the transaction would have saved several hundreds of thousands of dollars and about 6 years of stress that they have with this $2 million asset potential tax issue hanging over their heads. So it looks like we have a question.
Matt, I'm thinking about a foundation, an example of a foundation whose sole purpose is medical research. And the entire amount of its largesse is issued in the form of grants to a very limited number of medical professionals that may or may not have a personal relationship with the organization, but it's a very small group that receives the entire endowment on a regular basis. What is the risk of and let's say, for the sake of argument, that those grants are not open, they're not bid, they're awarded. What's the risk of that being private benefit?
Yeah, John, Matt, I'll let you take this. We do need to keep moving this along, and let's. There's a million different factual scenarios like this that we can address and opine on all day long. But Matt, why don't you use this as an opportunity just to distinguish, maybe help better distinguish private benefit from private inurement, since there could be inurement issues here as well, depending on whether these grant recipients control the organization, whether they be considered insiders or disqualified persons, what they're giving in return for what they're getting. But to me, in these situations, it's the private benefit concerns and whether there's even a sufficiently large charitable class that are the bigger issues.
Okay. First of all, it's difficult to go based on just those facts, because a lot of 4958 does require to have the sort of insider relationship. And while an outsider may be deemed for some purposes to be an insider, unless the doctors that you're talking about were either employed by the organization and sort of controlled the organization somehow, or the founder of the organization, it'd be very difficult for the IRS to prove a case for 4958. And Jeff brings up a good point with private inurement, private benefit here, because while the individuals may not necessarily be at risk of being taxed individually on this grant, these grants, if they are provided for the benefit of these individuals, may cause the organization to lose its exempt status. Because regardless of whether they are insiders, they are private individuals. So if they are just blanket grants to use as you want, and there's no bid, and they don't provide any services in return, then there is a possibility that the IRS will say, well, look, organization, you are being operated just to benefit this small pool of doctors, and because of that, you are conducting a private benefit. And it doesn't matter that they're not related, because there's a case out there where the Republican Party, the entire Republican Party was benefited, and a tax court said that's sufficient for a private benefit, even though you have no official relationship with the Republican Party. You just sort of do activities that are generally Republican-ish. So even if there's no specific relationship with those doctors, and to the extent that there is, it makes it appear worse, there may be a private benefit issue. That organization could protect itself if it is truly a grant-making organization, and it sounds like it is, by making the grants for specific purposes and requiring that the grants be used in furtherance of those specific purposes.
Yeah, I may add. Really, what we're trying to distinguish here between is if there's just a small group of recipients, whether individuals, companies, even other nonprofit organizations, but if it's a limited group and those are the sole or primary beneficiaries year after year of the organization, that is likely going to raise some private benefit issues, particularly if they're individuals or companies, because it's going to be that the organization there's impermissible private benefit because there's more benefit to them than there is to the general public. The way that most organizations deal with this issue without jeopardizing their exempt status is by having a competitive process. So it doesn't mean you have to offer 100 grants as opposed to only 5. You may only have funding for 5 grants a year. But what you do is you establish criteria, you open it up to all eligible candidates, you go through a review process, and then you pick the candidates year after year who are most eligible for those grants. And hopefully it's not the same group of 5 doctors year after year if you do that. And that's why the IRS is always very interested in asking when it comes to grants and scholarships and things like that. They want to know what kind of procedures do you have in place to ensure that the same group, whether it's the same group of 5 doctors or the children of all the board members or whoever it is, that there's not some unduly small group of beneficiaries year after year. All right, let's move on, Matt, to next topic.
Okay, just one more thing on that. Another way to protect the organization can protect itself is by engaging in expenditure responsibility, by giving the grants for a very specific purposes and requiring that these individual doctors report to the organization how the grants were specifically used for those purposes. One of the before moving on to this slide, the reason that I think 4958 is substantially important here is because it's an issue that I sort of mentioned, the enforcement and how the IRS ebbs and flows and how it enforces things. 4958 is an issue that the IRS hasn't enforced for a long time. The IRS enforced it a lot in the beginning. Then they got their butts kicked in a case really badly. The court just spent like 7 pages talking about how horrible the IRS was and how dumb they were for trying to go after this case. It's great. The case is Karachi. If anyone wants just a good read to see how the IRS just gets beat up. If you want, you can my contact information. I will email you a copy of it. So, but I've read the case like 100 times. It's great.
It is a disease.
And the IRS, after that case, the IRS really backed off of 4958. And so there's a period of 7 or 10 years where there's almost no enforcement on this. And 4958 has sort of fallen by the wayside, and practitioners sort of focused in advising organizations. And I really wanted to focus on this here because this is something that sort of the College and University Report highlights it, and it's something that we've seen the IRS talk about in speeches several times. And it's something that we've seen. I've seen it just to represent my own clients, the IRS assert 4958 13 or 14 times just in the last couple of years alone. So it is something that the IRS is very much focused on. And I don't want you to get the wrong impression. The IRS doesn't win these issues. My clients are all wonderful organizations that only provide the best services and never compensate each other higher than they should. But the IRS is being very aggressive with this. And so that's something to keep in mind as you try to protect yourselves and your organizations. And a lot of the colleges and universities tried to do that. The report noted that 94% of schools examined attempted to establish the rebuttable presumption. And even 50% used compensation consultants. However, despite their efforts, still 20% of the organizations failed to sufficiently protect themselves. Either the comparability data was not appropriate, the compensation studies weren't used properly. So it's not enough just to have a comparability report. It's not enough just to say, we looked at other organizations. If you are a small community health organization, do not look at Exxon's SEC filings to decide whether or not compensation is reasonable. You've got to make sure that the organizations you're comparing yourself to are similar, and be very careful and protect yourself. It's not enough just to say, we looked at other organizations. You've got to actually look at appropriate organizations.
And one final point on this, as Matt indicated at the outset, the intermediate sanctions penalties are only applicable to insiders of 501c3 and 501c4 organizations. They are not applicable to, say, C5, C6, or C7s, others that I know are represented here in the room and on the phone. That being said, the IRS Form 990 does ask all exempt organizations if you have followed these steps in setting the executive compensation of your key executives. And generally, we highly recommend following the steps of the rebuttable presumption for all tax-exempt organizations in setting executive compensation and approving any related party transactions. It just goes a long way to protecting the organization from finding a private inurement, which does apply to, say, 501c6 organizations. And it's just a best practice generally.
One last thing with the compensation that the report noted, and this probably does not apply to any organization that's listening to this or anyone that's representing organizations that I'm presenting to now, but I thought it was really interesting. The IRS talked about, and didn't really come to a conclusion on, but talked about compensation provided to non-officer directors, trustees, or key employees. Specifically, because this was colleges and universities, they looked at compensation of coaches. Sports coaches tend to have very high compensations compared to faculty or others who may be more clearly providing a service that directly relates to the organization's exempt purpose. This was something that was raised and not really, there's no definitive ruling on this or anything that can be used on this, but I just thought it was very interesting because this is something that is becoming an issue, and whether or not coaching salaries are necessarily reasonable. I know that my sister and my brother-in-law went to the University of Alabama, and they will go to their graves saying that Nick Saban's $5.6 million is very reasonable. In fact, he should probably be paid more. They wouldn't mind so much if it was he was named chancellor or whatever. I know that my other sister at Ohio State believes that Urban Meyer's $4.8 million is very reasonable because Ohio State's undefeated right now. And Meg herself told me that she believes that Mike Krzyzewski, if anything, is underpaid. So you're going to have a lot of issues with this, but those are large numbers considering that these individuals are not responsible for anything other than a very small activity for the organization.
So to kind of sum everything up that we've been talking about, the report is a very useful guide for colleges and universities and for all tax-exempt organizations. And this is true for a couple of reasons. The report provides lessons to organizations who are subject to ongoing compliance projects or might be subject to future compliance projects. And it highlights these two issues that are really of interest to the IRS right now. And it also provides a preview of what issues the IRS is going to be focusing on in the next 5 or 10 years. And for colleges and universities in particular, the report is a really good metric for comparison and a guide for what the IRS considers optimal compliance with the tax law. And with that said, Matt is going to touch really quickly on a couple of the more specific lessons that we can draw from the report.
Yeah, stuff that every organization really needs to be aware of based on the report is, first, if you receive a compliance check questionnaire, complete it. As I said, 13 of 13 that didn't complete it were examined, and 30 of 21 of 387 that didn't complete it were examined. So your odds of getting examined, of not getting examined, are much, much better if you complete this. Even if you are not inclined to complete it, send in a very shoddy form if you want, but just make sure something gets in because your odds of getting examined will be reduced drastically. Second, be prepared for unrelated business income tax issues and compensation to be the focus of any examinations. If you are, even outside of a compliance check area, if you are notified that you're going to be subject to an examination, these are the issues that the IRS is looking at right now. Every agent that was part of the compliance project went through a substantial amount of training on unrelated business income and compensation issues. Therefore, if these agents go out and examine your organization next, even if they're not told to look for these issues, that's just what they were trained to look for. That's what they're going to be looking for the foreseeable future when they're going out on examinations. Also, there's a lot of internal guidance, and especially because of where the economy's been, compensation issues are one of the few areas where in unrelated business income are the few areas where organizations can pay tax. So if the IRS is looking to raise revenue with respect to examinations, these will be a focus. Specifically with compensation, review your methods for approving compensation, your policies for approving. You should establish and implement policies. This is good, not necessarily just to establish rebuttable presumption, but having policies like this generally work for the best interest of an organization. I have yet to hear of an organization that established a policy of having independent people review the proposed compensation and compare it to other similar organizations that resulted in a situation where they found themselves overcompensating their officers or directors. Usually you see when people provide overcompensation because they didn't have independent people and they didn't compare it to other organizations. The insider said, I should be paid X amount, and the board said, sounds good. So if you have policies in place that slows down the process, that takes the individual out of it, and you lose a lot of the self-interest, and you protect your organization, and even from beyond just the rebuttable presumption, you're going to have a better result.
Matt, one corollary to that, if you are an organization that is pushing the envelope of compensation, whether it's for your chief executive officer or an outside consultant or whatever the case may be, but if you are going to push that envelope, regardless of how large you are, it could be a smaller organization that's just paying more than the norm to try to attract and retain a very talented CEO, or it could be a very large organization that's paying, at the top of the scale in terms of nonprofits. But if you are, it just goes without saying that if you're not pushing the envelope, if you know your people are really underpaid, we still recommend following these steps, but it's not as critical of an issue to go out and hire the absolute top best compensation consultant you can find to do a very specialized study for your situation, and off-the-shelf salary surveys and things like that, and looking at other Form 990s of similarly situated organizations might be enough in terms of sufficient comparability data. But if you know or you think that you're pushing the envelope, it really is worthwhile to invest in a good compensation consultant to come in and help. And we know this from a lot of personal experience, work with someone like Matt or someone else who can really dissect a compensation study and tell you how strong or weak it is. We have unfortunately reviewed quite a number of compensation studies, Matt in particular, where we found a lot of weaknesses in those studies, weaknesses that the IRS would find if they were to try to shoot holes in that. So if you are going to push the envelope, it's worth it to spend a little extra time and money to help shore up your defense.
One more thing with that. I am not an accountant. I am not a valuation expert. But I've seen dozens and dozens of compensation studies. And if someone with my lack of financial knowledge can pick apart a study in 30 seconds, then the IRS who's trained and the engineers at the IRS who are trained to look at these things will be able to do the same. So when hiring a consultant, it's important to do your research and make sure you're hiring someone that is reputable. I know that's often hard for organizations that do this once every couple of years to do. I keep a list of consultants that I've worked with before that I like, that I respect, whose work I wasn't able to just tear apart. So anyone that's participating in this conference, feel free to send me an email or give me a call and tell me your situation, and I'll give you, if I think that I've got some people that I think are appropriate, I'll give you their names so you can contact them yourselves and see how comfortable you are. I promise I won't try to sell you or anything like that. I'll just give you the names and try to get some information from you just so I make sure you recommend the right people, because it's important that if you're going to spend the money to obtain this protection, that you're getting protection that's worth the money that you're spending. Seek and use outside advice. I think we've covered that. And finally, for smaller organizations that can't afford a consultant, that you're concerned that you've got issues, consider using your trade associations and pushing your trade associations to provide some of this information, to provide sort of salary surveys of the industry, which would be similar organizations, to hire outside consultants to provide specific guidance that can be used by the industry, and it wouldn't necessarily be the same as direct legal advice, but it can provide you with some guidance so that you're protecting yourself, so that you have an idea of what you should be doing as part of your industry for an organization of your size. And finally, for more complex and bigger issues, consider the use of subsidiaries to engage certain activities. if you're entering into activity and you're concerned that this is going to be a substantial unrelated activity and it may result in UBIT or may taint other portions of your organization's activities, consider using a subsidiary. That's something that that some of the colleges and universities were sort of blasted for having a lot of subsidiaries and not really using them the way they should. And if you do have a subsidiary and it's a pass-through, make sure that you're treating the taxes right. I can't tell you specifically how to do that, just an example like that. But rely on your accountant and really focus on this issue when dealing with the tax issues related to that.
Matt, we had a question from the webinar asking, what are some common problems that you've seen with compensation studies? And when you found some flaws, what are some of the things that have jumped out at you as being common problems?
The biggest problem I see with compensation studies, I guess the problems fall on two sides. One, there are several compensation studies that are done to achieve the highest possible amount no matter what, and they're problematic. And then there are some compensation studies that are done in a manner that is inherently flawed, such that the compensation amount that's deemed to be reasonable is substantially less than it should be. I will go to the less than it should be first because people tend to not want to get less than they should. So in looking at that less than they should be situations, I've seen compensation studies where organizations were compared to, and I'm thinking specifically of an LA organization. LA is a big city, a very expensive city. And the compensation study I looked at compared the chief executive officer salary in LA to a similar title for organizations in Des Moines, I forget all the cities. Providence was one, but Providence is a city. But throughout the country, and there are about 15 cities or 15 organizations on the list, and of those, 10 were from cities of less than 100,000 people. And while some of them may have been suburbs of larger cities, you can't necessarily compare. And I've been to Des Moines. I've got family in Des Moines. Very nice. I'm not trying to say Des Moines is not a great place. You should all go. The corn is fresh and excellent. But Des Moines cannot be compared to LA, especially with respect to cost of living and other expenses in any way. As far as the problems with the higher compensation ones, I can almost always tell immediately when the compensation consultant was told, I think that I want to make X dollars, show me that's reasonable. And you have situations where I don't think I've ever seen it as drastic as Exxon, but where for-profit organizations that have a very, very tenable relationship to the industry that the organization is in are used to inflate the amount. Also, you see a lot of sort of pushing as to what is comparable. If you have a compensation study and your organization is compared to organizations that are all 2 or 3 times the size of your organization in terms of overall budget, it's fine to have a couple of larger organizations for aspirational reasons, but if every other organization on the list is 2 or 3 times the size of your organization, then the IRS is going to come in and say that is not a comparable study. Those are not comparable organizations to yours. So there are lots of issues to look at. You want to look at not just the title, but the responsibilities. If your CEO serves as the chief executive officer, the chief of operations, the chief of finance as well, he's going to have a lot more responsibility than a CEO who is very specific and just has one position with a large management team underneath her. So it is something that there are lots of issues. I can go on, and I like to hear myself talk, so I would, but you probably all have stuff to do.
Okay. Any other questions for Matt or Meg? I think we've answered all the questions on the phone. While that being said, it's 2 o'clock Eastern time to wrap up. Matt and Meg, thanks for a terrific job today. Thanks to all of you for coming, and we hope to see you back here next month.